Hi, good morning, everyone. Thank you for taking the time to come to listen to the Galaxy story. I'll kick off just by giving everyone a broad overview of our portfolio of assets. So Eric mentioned our Australian asset, which is actually a hard rock lithium production mine based in Western Australia. It's in a place called Ravensthorpe. It's about 400 kilometers away from Perth in the southern part of Western Australia. That is a 16-year mine life. It's an operation that went into care and maintenance about 2 years ago. It is about to go back into production at the end of this month, and for the better part of this year, we'll be ramping up production there. We're expecting about 60,000 tons of lithium concentrate to be produced from that, ramping up to double that in the course of the next year as well. We also have another hard rock project. It's a pre-DFS stage, so it's slightly earlier stage. It's based in Quebec province in Canada in a place called James Bay, and we'll be starting DFS work on that this year. But last but not least is Sal De Vida, which is our lithium and potash brine in Argentina. It's our flagship development. It's located in the Salar de Hombre Muerto, which is actually the same salar as FMC Lithium. FMC, for those of you who are familiar with the lithium sector, are one of the big three producers in the world, and we actually sit on the same salar as them. We've already completed a DFS on that, and we'll be moving forward on that project through the course of this year. Importantly, we also used to have a business in China, which recently I ended up divesting last year, primarily as part of a balance sheet restructuring exercise. But as a result of that, we actually ended up building a customer base in China of over 40 clients, very much involved in the lithium battery material sector. So all of them were either cathode producers or electrolyte producers. And the reason why China is important, and Asia generally is very important for the lithium battery sector, is if you look at that bar chart at the bottom right-hand corner, China today has a greater than 50% share of total lithium battery manufacturing capacity in the world. And it actually dwarfs Japan and Korea by over 50%, by those next two countries combined as well. So as a result, many of the materials that get produced for that downstream business are actually produced, those chemicals are produced in China. So a little bit different from probably some of the other lithium companies that you would have seen. We're probably one of the only few that actually has a diverse asset base in both hard rock and brine resources, which are the two main producers of lithium in the market today. But also importantly, we have a near-term production and also imminent cash flow coming into the company. Bit of a corporate background. Today, share price closed about 25 cents, so we have about a just under 320 million Australian dollar market cap at the moment. Our net debt is only about $20 million. That is something that I ended up working a lot on over the last 2 or 3 years. I became CEO of the company in June of 2013 when the company actually had a net debt peaking at about $207 million. So we spent a lot of time restructuring the balance sheet. Since then, obviously, after the completion of that restructuring, you've seen a return of value to the share price. But importantly, our institutional shareholder base has also been slowly building up as well. You see some probably familiar names for everyone in Switzerland on our registry there. You see UBS and also banks as well. Management, we own about 5% of the company. I'm actually ranked as the number 10 shareholder within the organization. So what's happening in lithium? In summary, the world consumes, as of 2015, about 160,000 tons of lithium carbonate equivalent, LCEs, per annum. That was the number for last year. Out of that, China will probably consume about 70,000 tons of that. And the rest actually, in terms of the mix of different applications, 40% of that 160,000 of LCE actually ends up going into battery applications. So they're either used in cathodes or in electrolytes or in separators. And obviously the battery sector is the segment which is actually growing the most rapidly over the past 5 years and obviously over the next 10 years as well. Lithium itself is actually also used in glass, ceramics, frits, thermoplastic, grease, and also it's used as a prescription medicine. But obviously the battery sector is the one that's growing the most rapidly at the moment. Over the next 5 years, we should see another 100,000 tons of demand coming online in the market. And from 2020 to 2025, another 100,000 tons. So 200,000 tons of demand coming online, and that is primarily driven through, as you can see on the right-hand chart, essentially consumer electronics, which we all have in our pocket today, all contain varying amounts of lithium. That sector alone will actually double its consumption over the next 5 years. Not necessarily because the number of phones and number of tablets that are being sold are going to double, but because each generation of device that we all consume actually increases the amount of lithium that we consume. So if you're someone like me who has 2 phones plus a backup battery, that's the equivalent of 1 person carrying about 6 or 7 phones. Each generation of device are getting more powerful, and when they get more powerful, they also require more power. So for those of you who bought the first generation of the iPad, that was a 25 watt-hour battery. By the time you actually upgraded to an iPad 3, you stepped up to about a 42 watt-hour battery. So just in that switching alone, within 2 or 3 years, each average consumer of that device would actually consume probably somewhere between 60 to 80% more lithium just for that device. So that's why consumer electronics continues to be very, very robust. Obviously, the sector that gets a lot of headlines is the transportation sector. And I would use the general term of transportation as opposed to, strictly speaking, electric vehicles, electric cars. Obviously, the likes of Tesla and Elon Musk gets a lot of headlines, and they make fantastic marketing for our industry. But my definition of transportation is what I would call the Asian or the Chinese definition of transportation, which actually is not just vehicles which have four wheels, but those that have 2 and 6 and 8 and 10. Bikes are as big as cars in China. Last year, China sold about 379,000 electric vehicles, new energy vehicles, which is about 70-80% of the North American, of the US number already. 2 years ago, it was less than 5% of the US, so that is growing very rapidly. But bikes are important. There are over 200 million electric bikes on the road in China. Historically, those were all powered by lead acid, and they're slowly being converted over to lithium. And last but not least, buses and government fleets. So the last 13th five-year plan and Premier Li Keqiang has been launching initiatives where they're encouraging government fleets to be adopting lithium battery or new energy vehicles as up to 50% of their fleet. And the target for China in terms of having buses on the road which are electrically powered by 2020 is going to be 200,000 vehicles. And as you can imagine, the size of a bus is actually probably about anywhere between 5 to 10 times the size of a Nissan Leaf. For those of you who are interested in mathematics, one Nissan Leaf is the size of 1,000 iPads. So you can tell through those numbers that we don't actually need a lot of vehicles on the road in order for them to actually consume a lot of lithium. Last but not least is the sector of what we call mass energy storage or distributed storage, which today is still a very, very small sector of the market. But within that 5 to 10 year period, we expect that this is going to be growing as well. These are off-grid storage systems. They could be backup battery storage for your solar panels on your roof, if it's residential complexes. If it's small communities, they could have essentially peak shaving, allowing kind of renewable energy to actually be fed from off-grid into a buffer before they're coming back onto the grid sector. And in my view, probably 10 years on from now, we wouldn't be surprised if the distributed storage sector actually became a bigger segment in lithium batteries than the cars did. So what's happening in China? A lot of government policies to actually drive growth there. Essentially, supply of lithium products, both in terms of the raw materials and the final product, has been extremely tight in China today. That's why you've seen an increase in pricing, quite robust increase in pricing. So today, depending whether you're on contract or off contract and basically trying to buy on spot, the price is probably somewhere between 2 to 3 times of what it was last year. We have started to see some of the big three, for example, FMC is starting to follow the China pricing now as well. And essentially today, if you buy small volumes of 50, 100, 200 tons, then you're playing close to somewhere in the region of about $20,000 net. If you're buying on volume 4,000 or 5,000 tons, the last major auction price that we had for that was about $12,000 to $13,000, which is a full 2 times of what it was last year. In our view, in my personal view, I think even if pricing does correct from that lofty $20,000 a ton, I think we will be seeing 5-digit pricing for lithium for quite a long time. So electrification of China's transport sector, I think I've talked about this already. A lot of initiatives going on at the national, provincial and municipal level. A lot of policies to encourage that. China's also set a target to actually install about 4.8 million charging stations around the country to match the vehicles that will be deployed. And obviously, a lot of that growth has been driven by private companies who essentially would then get subsidies and also cheap financing from government-sponsored agencies as well. So I guess what we're trying to say here is China does have a fairly pivotal role to actually play in the lithium battery sector, and it is somewhat counter-cyclical. Obviously, there are sectors in China which are not doing so well, such as heavy industry and real estate and infrastructure. But because of China's push to adopt more green technology, to reduce the levels of pollution in some of their major cities, so for those of you who have recently been to, obviously, the likes of Beijing and Shanghai, would understand how big a problem that is. And then last but not least, China obviously has a more long-term strategic play to reduce its reliance on imported foreign oil. And so electrification of transport is very much front and center of their strategic plans. In terms of how we compare to some of our peers, we're quite unique in that we actually have both a hard rock and a brine asset of considerable size. Obviously, given what's been happening in the pricing in the lithium sector, you would obviously see a lot more names that have come into the market in the recent 6 to 12 months. I was recently told by one of my broker friends in Australia that apparently there are now 26 companies in Australia which actually purport to have some sort of lithium as part of their project. But actually, if you do the comparison, it tends to be a very, very small group of those who are basically either one in near-term production or near-term cash flow. Many of those other companies basically do not even have a resource. But in terms of EV per resource and also EV per production capacity, I think we are still valued very, very moderately compared to some of our peers as well. One of which actually, probably most of which actually only has a single project to their name. So just to go through the projects, Mount Cattlin, this is a 17-year mine life. We have a partner on this project, is an operating partner called General Mining, also listed in Australia. They have a 50% earn-in over the next 3 years, where each year they actually have to pay us a $6 million a year minimum guarantee. We share operating cash flows on a 50-50 basis. I've just finished recently negotiating offtake with some of our Chinese customers. We have now priced that offtake at about $600 per ton of lithium concentrate. For the calendar year of 2016, we'll be delivering about 60,000 tons. But going into 2017, our commitment is to deliver 120,000 tons for that, with pricing yet to be fixed, because our view is that we probably will still have some further upside in pricing coming into the fourth quarter of this year. I also managed to negotiate 50% prepayment on those contract values. So this project will actually be starting production at the beginning of Q2. And we expect our first maiden shipment from the restart of this project in July, August of this year. So what do the economics look like? This table shows an economic study that was done quite a while ago, in October of last year, and it estimated that it was 100,000 tons of production at an approximately $400 net selling price. And that yielded 40 million Australian dollars a year at the project level, which obviously is 20/20 split between the two partners. If you actually add back the $6 million minimum guarantee, that works out to be about $26 million to us and 14 to the partners. But actually, based on the new terms of the offtake, that's probably more likely going to be more like $600 a ton. So that basically adds 100,000 tons, $20 million, which is approximately 26 million Australian. So 26 million Australian additional straight to the bottom line, an additional 13 for us and for the other partner. So that takes our 26 up to about 39. And if you look at the company on a free cash flow basis, our annual, I would say, cash burn in terms of corporate overheads and also carrying costs for Sal De Vida are about $5-6 million a year. And our debt servicing now is down to about $3 million a year. So you're looking at free cash flow of at least $30 million next year. So based on today's market cap, our free cash flow multiple is only about 10 times, and that basically values our other assets at 0. And obviously that's based on 2016 pricing. Most likely for 2017, we're going to be aiming for somewhere between a 10 to 20% uplift in concentrate pricing, because if lithium carbonate prices stay where they are at the moment, we decided not to be too aggressive in the ramp-up year. But also importantly, we'll probably look to add another 50% in production volumes next year as well. So fundamentally, there should still be some further improvement in terms of the fundamental performance of this project kind of going forward, and therefore in terms of the whole financials of the whole group. So Mount Cattlin, I've just gone through. We've just finished the lithium offtake, restarting production, and ramping up for the rest of the year. The ramp-up will actually be a non-typical ramp-up because it's not a new mine. We actually have about 400,000 tons of material in the tailings dam, which we can actually process very, very quickly. So we'll probably make use of about 3/4 of that because the mines department will require us to leave some material in the dam. And so essentially we won't be needing to mine, blast, drill or crush probably for the first 6 months of production. So the ramp up will be quite quick. Moving on to Sal De Vida. As I mentioned, this project is in Argentina. It straddles 2 provinces, Salta and Catamarca, and sits on the Salar de Hombre Muerto, which has FMC Lithium as our neighbor. FMC has actually been operating there since the mid-90s. So the infrastructure, the energy supply, local government is actually very, very pro-business and familiar with working with multinational corporations. It's got a 40-year mine life if we spec the project at 25,000 tons per annum. So we have about 1 million tons of LCE, lithium carbonate equivalent, and also about 4 million tons of potash as well. Those are some of the, I guess, hydrological and chemical comparisons of us compared to the other peer projects. Couple of things to look at there. Probably one is the size of the resource itself. Secondly, impurities are very important in the development of lithium projects because impurities are very detrimental to the performance of a battery. So the lower they are, the better it is, and also obviously improves cost as well. Some of the impurities that we actually look at are things like sulfates, but importantly magnesium. Magnesium has a very similar chemical behavioral property to lithium. So obviously if you have too much magnesium in there and you're trying to drop out the magnesium, you run the risk of dropping out the lithium and obviously reducing your recoveries and there as well. So magnesium to lithium ratios in projects in Argentina are typically quite low, around 2 to 3 times. In Chile, in the Atacama, they're about 4 to 6. Some of you may have heard that the largest reserve of lithium on this earth is in Bolivia. That technically is correct, but unfortunately Bolivia has very, very high impurities. So you have a magnesium-lithium ratio of over 20 times, which basically makes Bolivia very uneconomical, at least in current prices, to actually produce lithium. The other metric to look at, obviously, is your potash ratios, your potassium ratios, because obviously those can lend significant credits to your operating costs. As I mentioned, we've completed a DFS on Sal De Vida already. This was done in, the original DFS was done in 2013. We're actually going through a formal revision of that DFS primarily for a couple of reasons. At the time, our capital cost estimate was about $369 million US dollars. Since then, obviously, we've had a change in government in Argentina. So with Macri stepping in to take over from Cristina, we've seen a lot of policy changes, very positive changes. We've seen a 40% devaluation of the peso, and that's important for us because close to 60% of our capex is actually peso denominated. So we're expecting to see some positive movement on the capital number there. Other things have been removed, such as tariffs and also withholding tax on export of industrial products, which will improve the bottom line by another 5%. So generally, Argentina has become very, very positive as a market to do business in and to invest in, which is probably very different from where it was a few years ago. The MPV that we had at the time was $380 million US dollars. However, that was assuming a $5,500 US dollar per ton selling price of lithium. Today, if we're seeing $15,000 to $20,000 selling price per ton, I think the revised DFS that you will see will probably have a new selling price of somewhere between $10,000 to $20,000 US dollars, and just doing the back of the envelope, this will probably lift the MPV to north of $1 billion. The way that we'll be looking to get this project financed is probably not to tap equity at the parent level, so we're big believers in trying to preserve shareholders' equity. But after formalizing the revised DFS, we'll probably look to sell down somewhere in the region of about 20 to 30% of the project to actually raise financing at the project level. out of that $360 million, if that number stays exactly the same, the guidance that I've received from our potential bankers, such as ICBC and CDB, and also Rio Santander in Argentina, is that we can probably aim for about 60-70% debt equity financing. So that basically means that the equity component that's required for the projects is only about $120 million, which is very, very doable of a $1 billion MPV. So in terms of our action items for this year, formal revision to the DFS, we expect that to be completed by the middle of the year. We're also assembling an owners team. Lithium projects in South America, there aren't that many, and there definitely aren't that many that have been built over the last 20 years, actually only 3. So it's very important for us to actually bring in a lot of grey hair and industry expertise into this. The average team member will probably have somewhere between 20 to 40 years experience in operating and developing these projects. So we're putting that team together as we speak. We'll be reactivating our pilot program, which we previously built. And last but not least, the strategic joint venture, the sell down of the 20-30% stake that I mentioned just now will be probably proceeding on in the second half of the year. Last but not least, we have James Bay. This is a pre-DFS project in Canada. This is more of a mid-term option for us to develop in the event that the lithium demand does step up in the North American market. And as I said, we're probably looking to move ahead on some DFS work towards the latter part of this year. It's a very similar ore body to Mount Cattlin, hard rock, very, very low strip ratio, actually sits at surface, slightly larger resource, 22 million tons and a slightly higher grade, 1.28%. So in terms of near-term catalysts, I think we have multiple catalysts that can be moving us forward in terms of unlocking value. Obviously, we have imminent commencement of production at Mount Cattlin. We also have some tantalum offtake that we've yet to negotiate and finalize. There will be somewhere in the region of 60 to 80,000 pounds of tantalum that we'll be producing off of that, and obviously the selling price for that at the moment is somewhere in the region of plus or minus $70 per pound, so that will be accretive to us as well. Sal De Vida, the to-do items I've mentioned a little bit earlier. Last but not least, I think the macro themes for lithium will remain very, very robust for the next 3 to 5 years. In terms of the next 100,000 tons that's demanded over the next additional 100,000 tons per year demanded by 2020, in terms of the aggregate 300,000 tons of demand that will come online over the next 4 or 5 years, our view is that based on the handful of projects that have a possibility of 1, getting online, 2, getting to capacity, we're still looking at a 30 to 40% supply gap in terms of supply versus demand for lithium. And so I think robust pricing is going to be here to stay for at least the next 3 to 5 years. And last but not least, I didn't really mention it today, but the company has actually come out of a 2.5-year period of financial restructuring where we restructured and reduced a lot of the debt. So a lot of that share price recovery that you've seen recently is not necessarily reflective of fundamentals going forward. It's more just a recovery back to a normalized position as a going concern as a business. But I think based on what I've shared with everyone today, I think we have a lot of interesting times ahead and a lot more good news to deliver over the next couple of years. With that, thank you very much.
Thank you very much, Anthony. Are there any questions?
Sure. Yeah, Anthony, I wonder if you could talk a little bit about recycling lithium.
Yeah.
What that market's about.
Sure. So today, what a lot of people forget is that the lithium battery has actually been around for many decades. Sony first launched a commercial battery back in 1992. And as a technology, it's been around in the lab for about 50 or 60 years. But one of the things that is a misconception about lithium battery is that lithium actually constitutes a very large portion of the cost. In fact, it's not. Lithium ranges from somewhere between 2 to 5% of the cost of the total cost of the battery, depending on the type of chemistry and the type of battery that you have. So the analogy that I sometimes use is a food analogy. So it's a little bit like if we wanted to make a curry, we would normally have beef, potatoes, vegetables, some onions, and we also add a little bit of chili. Now the chili is the magic sauce that makes the curry, because without the chili you don't have a curry, you have a beef stew or you have a beef stroganoff. But if you think about the chili as a cost of component of the total cost of the ingredients, is very, very small. And so what that basically means is that based on today's economics, even in recent rises in pricing, the price of the lithium and the cost to actually extract it and get it out of get it back out of the battery is still probably less than economic today. Primarily because, as we all know, if we look at the metal recycling business of scrap metal for iron and steel, there needs to be a whole network of infrastructure that's built up to actually receive and distribute and collect kind of waste batteries, which obviously doesn't exist in the market today. Interestingly enough, the cost of copper and the cost of aluminium in a battery actually is much more than the cost of lithium. So I think while pricing is where it is today, I mean, there are some people who do, in current tight market situations where you try and get as many lithium values as you can, people will look at recycling. But that infrastructure, the recycling infrastructure in terms of receiving facilities, warehousing, and then actually trying to extract that does not really exist in the market today. No doubt, if this supply gap continues to exist over the next 3 to 5 years, that's probably another sector that we'd look at. But you know, today it's probably not a very big part of the industry.
One final question.
During the past 6 months, your stock price has increased tenfold.
Mm-hmm.
Your outlook is positive, but what do you expect during the next 6 months to repeat that momentum?
You're asking me if I expect another tenfold in the next 6 months? Okay. As I mentioned in my closing comments, the share price has really been to reflect coming back to life as a normal business. When I first took over the company nearly ran out of cash. I was brought in by our major shareholders, which included M&G, Vanguard, and Deutsche Bank, as well as a couple of Chinese strategic shareholders. At peak, the company had $207 million of net debt. The lowest cash balance the company at the time ran to was about $50,000. So in the course of all of that restructuring, I mean, out of that $200 million of debt, a lot of it was in China as well. And it wasn't one loan. It was like 29 different facilities, all of which were coming due at very different periods of time. The last 2.5 years, the management team and myself, we've been busy on just fixing the company while trying to preserve equity value. So we never tapped equity in the time that we were doing all the restructuring. We've divested one asset to shore up the balance sheet and bring back some cash, and we basically restructured, haircut some of our debt and some of our bondholders, but we've also kind of refinanced through other debt rather than through equity as well. So equity value is something that we hold very dear to our heart. In terms of where we've come in the last 6 months to where we are today, I think it's just reflective of, well, actually this business could actually potentially be a going concern. Now, if I go back to probably some of the fundamental analysis that I made during the presentation, if you look at the market cap today, my free cash flow multiple on a 1 year forward, so this is 2017, is probably about 10x. We could have a very long debate as to, for this type of business with this type of growth momentum on the demand side, should we be 10x, 12x, 15? I mean, we can put whatever number that we want on that. So I'm not really looking for value uplift from multiple accretion. I think fundamentals in any business, fundamentals need to take care of themselves. And so what's going to be happening in the next 6 to 12 months? Well, we're starting production at Mount Cattlin, and going into 2017, you probably will see production at Mount Cattlin based on those numbers that I gave just now for roughly $30 million free cash flow multiple. This deducts all of our other costs such as corporate overheads and debt servicing and development costs for Argentina, about $30 million. That's off the base of $600 selling price and 100,000 tons of lithium concentrate sales. That hasn't included any profit contribution from tantalum. It also assumes that next year we'll be staying at 100,000 tons, which is most unlikely because our customer commitments alone are already 120,000, and our internal target is to probably, our capex spend today already facilitates that project going up to 200,000 tons of capacity. So we will be aiming for somewhere in the region of about 150,000 tons of production next year. So that's somewhere in the region of, call it 40-50% uplift in terms of absolute earnings. Pricing. I mentioned earlier that I believe that $600 per ton pricing is actually quite moderate, and I'll explain why. The way that the relationship between the economics of a concentrate producer and a converter works like this. You need about 8 tons of lithium concentrate to produce 1 ton of lithium carbonate. So if my pricing is $600 a ton, and let's assume it costs another $50 to get from Australia to China and into inland China for logistics and shipping, you're looking at $5,200 per ton. Sorry, $5,200 per ton of lithium carbonate equivalent of feedstock plus delivery cost. On top of that, the cost of conversion in China ranges depending on the size, the scale of the plant, and the efficiency, from $2,000 per ton to about $3,500 a ton. I normally use about 3, so you're talking about $8,200 per ton all in. Well, today pricing in China ranges anywhere between $13,000 to $20,000 a ton. So even at the bottom end of that range, the converters today are making a very, very good margin. They're making $5,000 a ton off the back of a $13,000 selling price. That's at the low end. So they're making about a 35-40% margin. So if you look at the mix of margin at the moment, more of that margin is sitting with the converters. And the reason why I'm reasonably confident that if market prices stay where they are, I mean, first and foremost, I believe that the 20,000 may correct a little bit, but it'll probably correct down to somewhere between 10 to 15,000 US dollars a ton. Even at that kind of level, more margin is going to the converters. So my guidance, our internal kind of target is to probably lift pricing about 15 to 20%. So that will probably take us to about 750 US dollars a ton. At 750 US dollars a ton, plus the 50 per ton of shipping and logistics, that's 800 times 8, that's 6,400, add another 3,000. Okay, that's still 9,400 US dollars a ton all in for the converter to sell it at 13,000. So even at that level, he's still making 25-30% margin, and I'm getting a bit more of an uplift. So in terms of, I guess, near-term catalysts over the course of the next 3 to 6 months, obviously as we're getting kind of production back online and delivering product, but going into 2017, lifting volumes will add another 50%, up to 30, call it a range of, let's say, 30 to 50% in terms of bottom line earnings ability. And then obviously if pricing lifts somewhere between 10 to 20%, that will be accretive as well. So if you do the math off the back of that, then if our market cap is $300 million today, you know, it's probably going to be slightly moving north if we continue to deliver on fundamentals. And that, like I said, I'm not assuming any multiple accretion reflecting in value there. And that still basically assumes that the market is ascribing little or zero value to Sal De Vida and James Bay. And so what you will see in us in the near term, sir, is probably somewhere between kind of May and June, you will see us deliver some news flow on updates on Sal De Vida, specifically things around the revised DFS. So we'll have some new economic numbers out. We're going to have a very, very large MPV on that. And also you will see a very, very experienced owners team that we would have brought on board, which essentially would be former Rockwood and former FMC people who have literally operated in South America and on these projects over the last couple of decades. So I think, you know, like I said, as a generalization, I think going from $25 million market cap to a $300 market cap has been an interesting ride. But I think it's only just starting to get interesting from my perspective, from a fundamental delivery perspective.
Thank you very much.